$1.5 trillion. That's not a typo. That's the amount of commercial real estate debt coming due for refinancing in 2026, and most of it sits on the balance sheets of regional banks that are already bleeding from unrealized losses. We're not talking about a minor correction here. We're looking at a potential cascade that could make the 2008 financial crisis look like a dress rehearsal. Right now, as I'm recording this at the end of 2025, the clock is ticking. Regional banks across America are sitting on a powder keg, and the fuse is already lit. The question isn't if we'll see failures, it's how many, and how fast they'll spread through the system. I'm not a doomsday preacher. I don't make money from fear. I just look at the data, and the data is screaming at us. Every single indicator that preceded major banking crises in the past is flashing red right now. So in this video, we're going to break down exactly what's happening, why 2026 is the critical year, and most importantly, what you can do to protect yourself before this domino falls. Let's rewind for a moment. Between 2020 and 2021, when interest rates were at historic lows, I'm talking 0% to 0. 25%, there was an absolute frenzy in commercial real estate lending. Office buildings, retail spaces, multifamily properties, all of it was financed with cheap money. Regional banks, desperate for yield in a zero-rate environment, loaded up on these loans like there was no tomorrow. Fast forward to March 2022. The Federal Reserve begins the most aggressive rate hiking cycle in 4 decades. They took rates from near zero to over 5% in less than 18 months. Now here's the problem. Most commercial real estate loans have terms of 3 to 5 years. Do the math. Loans originated in 2021 at 3% interest rates are coming due for refinancing in 2024, 2025, and especially 2026 at rates of 7%, 8%, or higher. But it gets worse. The commercial real estate market is simultaneously collapsing. Office occupancy rates in major cities like San Francisco are below 50%. The work-from-home revolution isn't going away. Companies are downsizing their physical footprint. Retail is being decimated by e-commerce. The properties securing these loans have lost 30% to 50% of their value in many cases. So you have borrowers who can't afford to refinance at higher rates, and the collateral backing their loans is worth dramatically less than when the loan was originated. This is called being underwater, and it's happening on a systemic scale. Why specifically 2026? Because that's when the largest wave of commercial real estate loan maturities hits. According to data from TREP and the Mortgage Bankers Association, approximately $550 billion in commercial real estate loans mature in 2026 alone. And regional banks hold roughly 70% of all commercial real estate loans in the United States. These aren't the JP Morgans and Bank of Americas, these are the banks in your hometown, the ones that finance local businesses and properties. The Federal Reserve knows this. The FDIC knows this. That's why they quietly activated emergency lending facilities in early 2025, something the mainstream media barely covered. They're preparing for what they see coming. Let's get specific. As of Q4 2025, regional banks in the United States hold approximately $2.3 trillion in commercial real estate loans. Of that, $1.5 trillion is set to mature between 2026 and 2027. This isn't spread out evenly, the concentration is dangerous. Take a bank like New York Community Bancorp. In early 2024, they reported massive losses tied to their commercial real estate portfolio, specifically multifamily and office properties in New York. Their stock dropped 38% in a single day. But here's what they didn't tell you, they're not alone. Banks like Western Alliance, PacWest, and dozens of smaller regional institutions are sitting on similar portfolios. When a property owner took out a $10 million loan in 2021 at 3.5% interest, their annual debt service was around $350,000. Now, to refinance that same loan at 8%, they're looking at $800,000 per year. That's a 129% increase in debt payments. Can the property generate enough income to cover that? In most cases, absolutely not. Let's talk about office buildings specifically because this is ground zero for the crisis. According to data from CoStar, office vacancy rates in major metro areas hit record highs in 2025, San Francisco at 35.7% vacancy, Houston at 28.4%, Dallas at 26.2%, and Chicago at 22.8%. These aren't temporary blips. Companies like Salesforce, Meta, and Amazon have permanently reduced their office space requirements. When was the last time you heard a CEO say, "We need more office space"? Exactly. Never. Now here's where it gets scary. A typical office building needs about 85% occupancy to break even on its debt service. At 65% occupancy, which is optimistic given current trends, the property is losing money every single month. The borrower can't make the loan payments. The bank has two choices: extend the loan and pray things improve, or foreclose and take a massive loss on a property worth far less than the loan amount. Most banks are choosing option 1, which is called extend and pretend. They're rolling over bad loans, hoping the market recovers. But this only delays the inevitable and makes the eventual losses larger. Here's how this plays out. Let's take a hypothetical regional bank. We'll call it Midwest Community Bank. They have $5 billion in assets, with $2 billion of that in commercial real estate loans. Of those CRE loans, $800 million mature in 2026. As those loans come due, let's say 30% of borrowers default or can't refinance. That's $240 million in problem loans. The bank forecloses and sells the properties, but they only recover 60 cents on the dollar due to the depressed market. Suddenly, the bank has taken $96 million in losses. But wait, this bank's total equity capital is only $400 million. They just lost 24% of their capital in 1 year. Federal regulators require banks to maintain certain capital ratios. If Midwest Community Bank falls below those thresholds, they get slapped with a consent order, meaning they can't make new loans and must raise capital. But who wants to invest in a failing bank? Their stock price collapses. Depositors get nervous and start withdrawing money. Now the bank has a liquidity crisis on top of a capital crisis. Sound familiar? This is exactly what happened to Silicon Valley Bank and First Republic in 2023, except now it's happening to dozens of banks simultaneously, and the trigger is commercial real estate instead of duration risk on treasury bonds. Some of you might remember the savings and loan crisis of the late 1980s and early 1990s. Between 1986 and 1995, over 1,000 S&L institutions failed, costing taxpayers $132 billion, about $280 billion in today's dollars. What caused it? Deregulation allowed S&Ls to invest heavily in commercial real estate at precisely the wrong time, right before a massive downturn. Does this sound familiar? We're seeing the exact same pattern. Regional banks loaded up on commercial real estate during artificially low rates, and now they're facing a collapse in property values combined with impossible refinancing terms. The only difference is the scale. We're talking about $1.5 trillion instead of a few hundred billion. By the way, during the S&L crisis, the government created the Resolution Trust Corporation to liquidate failed institutions. Guess what? In late 2024, the FDIC quietly expanded its receivership capabilities and hired hundreds of additional staff. They're preparing for mass failures, even if they won't say it publicly. Now let's talk about something most people don't understand but is absolutely critical: unrealized losses on securities. This is the hidden bomb in regional bank balance sheets. When interest rates were near zero, banks bought massive amounts of treasury bonds and mortgage-backed securities yielding 1.5% to 3%. They classified these as held-to-maturity securities, meaning they plan to hold them until they mature and get their principal back. Under accounting rules, they don't have to mark these securities to market value. They can keep them on the books at par value even though they're worth far less. Here's the problem. A 10-year treasury bond yielding 2% that you bought in 2021 is worth about 80 cents on the dollar now that rates are at 5%. The bank hasn't technically lost money because they plan to hold it to maturity, but if they need to sell it for any reason, like a bank run or to meet regulatory capital requirements, they have to realize those losses. As of Q3 2025, the FDIC reported that U.S. banks are sitting on approximately $600 billion in unrealized losses on held-to-maturity securities. Regional banks account for a disproportionate share of this. Why? Because they were chasing yield more aggressively than larger, more diversified banks. Remember Silicon Valley Bank? They collapsed in March 2023 in under 48 hours. Here's what happened. They had $120 billion in securities with a market value of only $91 billion, $29 billion in unrealized losses. When depositors started withdrawing money, SVB had to sell those securities at a loss to raise cash. Once they announced they'd taken a $1.8 billion loss, panic ensued. Within 2 days, depositors tried to withdraw $42 billion, 1/4 of all deposits, and the bank failed. Now imagine this happening not to one bank, but to 50 or 100 banks simultaneously. That's the systemic risk we're facing. Banks like First Horizon, Comerica, and Zions Bancorp all have similar exposure profiles. They're sitting on securities portfolios with massive unrealized losses, and they're simultaneously exposed to commercial real estate deterioration. Here's where it gets truly frightening. When a few regional banks fail due to CRE losses, depositors at similar banks get nervous. They start withdrawing money. This forces those banks to sell securities at a loss to meet withdrawal demands. The securities sales realize the losses, reducing capital. Reduced capital means the bank must shrink its balance sheet. Shrinking the balance sheet means calling in loans or refusing to roll over maturing loans. Now your commercial real estate borrower can't refinance not because they're a bad credit risk, but because the bank literally can't lend anymore. So the borrower defaults. The bank forecloses. Property values drop further. Other borrowers in the area see their properties decline in value. More defaults. More foreclosures. More bank losses. This is called a deflationary debt spiral, and it's exactly what happened from 1930 to 1933 during the Great Depression, when over 9,000 banks failed. The Federal Reserve didn't exist in its modern form back then to stop the cascade. They do now, but can they move fast enough? Want to know what the smart money is doing? Look at insider trading data. In Q4 2024 and Q1 2025, executives and directors at regional banks sold stock at rates not seen since early 2008. We're talking about CEOs and CFOs dumping millions of dollars worth of shares in their own companies. Jamie Dimon at JP Morgan sold $150 million of his personal stock in Q1 2024, his first sale in years. Why? JP Morgan is actually well positioned, but even they see the systemic risk. When the CEO of the largest bank in America is de-risking his personal portfolio, what does that tell you? Similarly, directors at banks like KeyCorp, Fifth Third, and Regions Financial have been systematically reducing their positions. These are people with access to internal data we don't see. They know what's coming. Now we get to the scariest part, derivatives. Most people's eyes glaze over when you mention derivatives, but stay with me because this is where a regional banking crisis becomes a global financial meltdown. The global derivatives market is estimated at over $600 trillion notional value. A huge chunk of this is tied to interest rates and real estate. When regional banks start failing, counterparty risk explodes across the financial system. Here's a simplified example. Regional Bank A has commercial real estate loans. To hedge interest rate risk on those loans, they entered into interest rate swaps with Investment Bank B. Regional Bank A fails. Now Investment Bank B is on the hook for that derivative exposure. But Investment Bank B has its own derivatives positions with other institutions. When one party fails, the whole chain is at risk. Remember AIG in 2008? They were the largest insurance company in the world, and they sold credit default swaps, derivatives that insure against bond defaults, on mortgage-backed securities. When the housing market collapsed, AIG couldn't pay out on those swaps. If AIG had been allowed to fail, every major bank in the world would have taken massive losses on their AIG counterparty exposure. The government had to bail them out with $182 billion to prevent complete financial collapse. We're facing a similar situation now, but instead of one AIG, we have dozens of regional banks with complex derivative positions. Banks like Charles Schwab hold over $150 billion in derivatives notional value. Truist Financial has over $300 billion. These aren't investment banks, these are regional commercial banks. When multiple regional banks fail simultaneously, who's on the other side of their derivative contracts? Other banks. Insurance companies. Pension funds. Money market funds. The interconnection is frightening. Let's talk about commercial mortgage-backed securities, or CMBS. Banks originate commercial real estate loans, then package them and sell them as securities to investors. There's about $600 billion in CMBS outstanding, with regional banks holding a significant portion on their balance sheets. As commercial real estate defaults rise, CMBS values plummet. A CMBS security that was AAA rated and trading at 100 in 2021 might be trading at 60 or 70 now. Banks holding these securities face massive mark-to-market losses. Insurance companies and pension funds that bought these securities thinking they were safe are suddenly sitting on losses. Here's the cascade. CMBS losses force insurance companies to sell other assets to raise capital. That selling pressure drives down prices on treasury bonds, corporate bonds, and stocks. Now you have contagion spreading from commercial real estate to the entire financial market. In 2025, delinquency rates on CMBS office loans hit 8.3%, the highest since the Great Financial Crisis. For comparison, during the 2008 crisis, CMBS delinquencies peaked at 10.3%. We're almost there, and the wave of loan maturities hasn't even hit yet. Pension funds are required to maintain certain funding levels and return targets. Many pension funds invested heavily in CMBS and commercial real estate debt funds because they offered higher yields than treasuries. CalPERS, the largest public pension fund in America with $470 billion in assets, has approximately 8% of its portfolio in real estate. That's $37.6 billion. When commercial real estate values drop 30% to 40%, CalPERS and funds like it face massive losses. This creates a funding crisis. They can't meet their obligations to retirees. Now you have political pressure on states and municipalities to bail out pension funds. Where does that money come from? Higher taxes or more government debt, which feeds inflation. This is how a regional banking crisis becomes a sovereign debt crisis becomes a currency crisis. The connections run deep. So how do you know if your bank is in trouble? Here are the specific metrics and warning signs. Commercial real estate concentration. Look at the bank's 10Q and 10K filings. If commercial real estate loans exceed 300% of the bank's total capital, that's danger zone territory. For context, regulators consider anything over 300% to be concentrated exposure. Texas ratio. this is total non-performing loans divided by tangible common equity plus loan loss reserves. A Texas ratio above 100% means the bank would be insolvent if all bad loans had to be written off. During the 2008 crisis, banks with Texas ratios above 50% had an 80% failure rate within 3 years. Unrealized securities losses. Check the bank's accumulated other comprehensive income line on the balance sheet. Large negative numbers indicate unrealized losses on securities. If AOCI losses exceed 15% of tangible equity, be concerned. Deposit flight. Look at quarter-over-quarter deposit trends. If deposits are declining while competitors are stable or growing, that's a warning sign. First Republic lost 40% of deposits in Q1 2023 before failing. Loan-to-deposit ratio. A healthy ratio is 80% to 90%. Above 100% means the bank is lending more than it has in deposits and relying on wholesale funding, which can disappear overnight. I'm not going to name specific institutions and tell you they'll definitely fail, that would be irresponsible and potentially litigious. But I will tell you to look at banks with these characteristics: heavy concentration in office building loans, major exposure to California, New York, or Texas commercial real estate markets, assets between $10 billion and $100 billion, too big to easily sell, too small for guaranteed government support, and rapid growth from 2020 to 2022, which means they were probably reaching for yield. You can find this information on the FDIC's website under Bank Find Suite. Every bank files quarterly call reports with detailed balance sheet information. It takes 30 minutes to look up your bank and check these ratios. 30 minutes could save you from losing everything. In October 2025, the FDIC and Federal Reserve sent private letters to over 60 regional banks requiring them to submit resolution plans, basically, instructions on how to wind down the bank if it fails. This hasn't been widely reported in mainstream media, but industry insiders know about it. Similarly, the Federal Reserve expanded its bank term funding program in mid-2025, allowing banks to borrow against securities at par value rather than market value. This is an emergency liquidity backstop. They only do this when they see serious systemic risk. The OCC, the Office of the Comptroller of the Currency, increased examination frequency for banks with CRE concentrations above 300% of capital. They're not announcing this publicly, but examiners are crawling all over these institutions. When regulators take these actions quietly, it means they're preparing for the worst while trying not to spook the public. It's like seeing flight attendants discreetly checking their emergency equipment. You should probably pay attention. So what can you do to protect yourself? Here are 8 specific actions in order of priority. Priority number 1, diversify your bank deposits. The FDIC insures deposits up to $250,000 per depositor, per institution, per ownership category. If you have more than $250,000 in one bank, you're at risk of losses if that bank fails. Yes, the FDIC will likely cover uninsured deposits like they did for Silicon Valley Bank and Signature Bank, but do you want to bet your life savings on political decisions? Spread your deposits across multiple banks, ensuring no single institution holds more than $250,000 of your money. Use different ownership structures, individual, joint, trust, IRA, to maximize FDIC coverage at each bank. Better yet, consider moving deposits to the largest, most systemically important banks. JP Morgan, Bank of America, Wells Fargo, and Citibank are explicitly too big to fail. The government will not allow them to collapse. Your deposits there are safer than at regional banks, period. Priority number 2, move to Treasury money market funds. Money market funds that invest only in U.S. Treasury securities have zero credit risk. Even if your brokerage firm fails, those Treasury securities belong to you, not the firm. Fidelity, Vanguard, and Schwab all offer Treasury-only money market funds yielding around 5% as of late 2025. This gives you liquidity, safety, and decent yield. It's better than keeping large sums in checking accounts at risky regional banks. Priority number 3, pay down variable rate debt. If you have variable rate debt, credit cards, HELOCs, adjustable rate mortgages, pay it down aggressively. As the crisis unfolds and credit conditions tighten, banks will reduce credit lines and increase rates. You don't want to be caught needing credit when banks are retrenching. Use excess cash to pay off the highest rate debt first. If you have a HELOC you're not using, consider paying it down or at least keeping it unused so you have access to credit if needed. Priority number 4, build a 12-month emergency fund. Financial advisors typically recommend 3 to 6 months of expenses in emergency savings. I'm telling you to double that. If we enter a severe recession with banking crisis contagion, unemployment could spike above 8% to 10%. You want a minimum of 12 months of living expenses in cash or near cash. Keep this in Treasury money market funds or short-term Treasury bills, not in banks with questionable stability. Priority number 5, review your investment portfolio for banking exposure. Look at your investment portfolio. Do you own regional bank stocks? Do you own bond funds with significant CMBS exposure? Do you own REIT ETFs heavily weighted toward office buildings? These assets are at severe risk. Consider rebalancing away from commercial real estate and regional financials toward large-cap tech with fortress balance sheets, consumer staples, people need to eat regardless of economy, healthcare with its aging demographics creating structural demand, and treasury bonds for flight to safety during crisis. I'm not saying sell everything and go to cash, but if 20% of your portfolio is exposed to the sectors we've discussed, that's too concentrated. Priority number 6, lock in fixed-rate financing now. If you own investment property or a business that requires financing, lock in fixed-rate loans now while you still can. When the crisis hits, credit availability will evaporate. Banks will stop lending except to the most pristine credits. If you have adjustable rate financing on rental properties, refinance to fixed rates. Yes, rates are higher than 3 years ago, but at least you'll have certainty and won't face refinancing into a dead market. Priority number 7, establish credit lines before you need them. Banks extend credit when you don't need it and deny credit when you do. Open credit lines now, personal lines of credit, business lines of credit, HELOCs, even if you don't plan to use them. During the crisis, banks will freeze or reduce credit lines. Having established credit now gives you optionality later. Just don't use it unless absolutely necessary, and make sure the terms are fixed, not variable. Priority number 8, consider physical gold and silver. I'm not a gold bug, but I recognize that in extreme scenarios where banking confidence collapses and currency debasement accelerates, precious metals serve as insurance. Allocate 5% to 10% of your net worth to physical gold and silver coins that you control directly, not paper ETFs, not gold stored in bank vaults, but physical metal in your possession. This is the ultimate break glass in case of emergency asset. If we have a true systemic banking collapse with bank holidays and capital controls, physical gold becomes extremely valuable. It's happened before. Roosevelt confiscated gold in 1933, Nixon closed the gold window in 1971. Don't assume it can't happen again. Now let me walk you through how this crisis will likely unfold in 3 distinct phases. Phase 1 is the initial shock, happening in Q1 to Q2 of 2026. The crisis begins when a prominent regional bank with heavy commercial real estate exposure announces massive losses and fails. This bank won't be a tiny community bank, it will be an institution with $50 billion to $100 billion in assets that everyone assumed was safe. The failure happens over a weekend after regulators take control on Friday afternoon. By Monday morning, depositors at similar banks panic. Social media amplifies the fear. Bank runs begin at institutions perceived to have similar exposure profiles. The Federal Reserve announces emergency lending facilities. The FDIC guarantees all deposits, not just insured amounts, to stem panic. Stock markets crater. The S&P 500 drops 15% to 20% in a matter of weeks. Credit spreads blow out. Corporate bonds and CMBS get hammered. The administration and Congress debate emergency legislation. Taxpayers are told they must bail out banks to prevent economic collapse. There's political backlash, but ultimately the legislation passes. Phase 2 is the contagion, happening in Q3 to Q4 of 2026. Even with government backstops, the crisis spreads. Why? Because the fundamental problem, too much commercial real estate debt at too high valuations, hasn't been solved. Banks stop lending. Commercial real estate owners can't refinance. Defaults surge. Insurance companies and pension funds report massive losses on their CMBS and real estate holdings. Some insurance companies fail or require government bailouts. State pension funds reveal their billions of dollars underfunded. Unemployment rises as businesses lose access to credit. Small and medium businesses that relied on regional bank financing can't get loans. Layoffs begin. Consumer spending declines. Recession deepens. Credit card defaults increase. Auto loan defaults increase. The crisis that started in commercial real estate spreads to consumer credit. More bank losses. More failures. The feedback loop intensifies. Phase 3 is the political response and inflation, happening in 2027 and beyond. Governments respond the way governments always respond to financial crises, by printing money. The Federal Reserve cuts interest rates back toward zero despite still elevated inflation. They restart quantitative easing, buying treasury bonds and mortgage-backed securities. Congress passes massive stimulus packages, infrastructure spending, direct payments to citizens, bailouts for pension funds. The federal deficit explodes to $3 trillion or $4 trillion per year. Initially, this seems to work. Asset prices stabilize. Markets rally. But the consequence is inevitable: inflation returns with a vengeance. All that newly created money chases a limited supply of goods and services. By 2027 to 2028, we're facing stagflation, high inflation combined with low or negative economic growth. The dollar weakens significantly against other currencies. Gold and commodities surge. Real wages decline as inflation outpaces wage growth. This is the endgame. The government chose to inflate away the debt rather than face deflationary depression. Savers and retirees on fixed incomes get destroyed. Asset owners, people who own real estate, stocks, gold, fare much better in inflation-adjusted terms. The parallels to the 1970s are unmistakable, except this time the debt levels are exponentially higher and the Fed has much less room to maneuver. Look, I could be completely wrong about this. Maybe the Federal Reserve successfully navigates this crisis. Maybe commercial real estate stabilizes. Maybe regional banks find ways to refinance their loan portfolios without massive losses. Maybe the derivatives exposure doesn't cascade into systemic failure. But here's what I know: every single indicator that preceded the 2008 crisis is present now, often at worse levels. Debt levels are higher. Asset valuations are more stretched. The banking system is more interconnected. And the policy tools available to authorities are more limited because we never truly dealt with the fundamental problems from the last crisis, we just papered over them with zero interest rates and printed money. So what's the cost of being prepared versus the cost of being unprepared? If I'm wrong and none of this happens, you've taken steps that make you financially stronger anyway. You've paid down debt, built emergency savings, diversified your banking relationships, and positioned your portfolio more conservatively. These aren't bad moves even in good times. But if I'm right and you haven't prepared, you could lose everything. Your bank could fail and tie up your deposits for months. Your investments could get crushed. Your job could disappear. Your retirement could be delayed by a decade. The asymmetry is obvious. The downside of preparation is minimal. Maybe you miss out on some speculative gains in risky assets. The downside of not preparing is catastrophic. I'm not telling you to sell everything and move to a cabin in the woods. I'm telling you to look at the data, understand the risks, and take reasonable steps to protect yourself and your family. That's not panic, that's prudence. The signs are all there if you know where to look. Regional bank executives are selling stock. Regulators are quietly preparing for failures. Commercial real estate is collapsing. Derivatives exposure is enormous. The timeline points to 2026 as the critical year. You have time to act, but that window is closing fast. Don't wait until the crisis is on the evening news, by then it's too late. The time to prepare is when things still seem calm on the surface, even though the fault lines are clearly visible underneath. Stay informed. Stay prepared. And remember, hope is not a strategy.